Absolutely. So Swiggy is going to be in focus because shareholders have finally approved capping aggregate foreign ownership in the company at 49.5%. At its AGM yesterday, shareholders approved special resolution to alter the company's articles of association with a 93.97% vote in the favor of this clause. And the same proposal, remember, had received only 72.36 approval back in May, and it was not able to clear that 75% threshold that it needed for this approval to fall into place. Shareholders have also approved a separate resolution to cap this foreign ownership at 49.5%, and this was met with a very strong response of 99.9% votes in favor of this resolution. These approvals are central to Swiggy's renewed push for becoming an IOCC, that's an Indian-owned and controlled company status. This move is particularly important for Instamart, and here's why. If Swiggy becomes an IOCC, it gains much greater flexibility around owning its own inventory. The shift will mark its movement from a marketplace model right now for Instamart to its own inventory model. There'll be deeper private label push, cheaper sourcing, warehousing structures will improve, margins in turn will improve after all of this, and operational structuring will also look better. This could materially improve the profitability for Instamart and also reduce the regulatory overhangs that come for foreign controlled companies. Remember, Swiggy had earlier said that it will take them to transition into an inventory model up to 2 to 4 quarters after this approval comes into place, which it now has. So we'll be watching out for this timeline. Just a little brush up on why this resolution did not pass in May in the first place. Now, to become an IOCC, more Indian board representation is required at, of course, the board level. And shareholders were earlier concerned that too much concentration of power will then lie in the hands of the board. After the management clarifying that this will not be the case, now this approval has been passed, and now Mr. Sriharsha Majeti, who is the founder of the company, will be able to nominate one person to the board. The co-founder of the company, Mr. Fanikishan Adepali, will also be able to nominate himself to the board, although this does not come with any veto right. So that is something to watch out for. The key clarification over here is that this only enables the company. It is a roadblock clearance to become an IOCC. The company has not yet become an IOCC. We'll be watching out for that. Now remember, to put this more into context, Eternal converted into an IOCC around this time last year. And the reason that they had given to convert, they said control on inventory will give them more leverage on margins. This will allow them to push harder and faster on assortment expansion. After doing the math, they said that they expected to see 1 percentage point margin expansion over time as a result of this transition. For quick commerce revenue, they said that they will become very similar to the net order value, the NOV, going forward. Hence, quick commerce revenue increased for them after they transitioned. Hyperpure revenue will decrease on account of scale down of the non-restaurant business. That is something that was particularly applicable to Eternal. They said that net working capital in the quick commerce business will increase as they start owning inventory, and that is something we're expecting to see for Swiggy too. No change in the quick commerce NOV. Once again, we're expecting this to offer Swiggy as well. And after doing all the math, assuming that each dark store needs typical 1 crore rupee in capex, Eternal said that working capital could rise from 1% of NOV under the marketplace model to 4 to 5% of NOV under the inventory model. We'll be waiting to hear some clarification from Swiggy in terms of what this does to their margins and the math behind dark store investments. But largely, in a nutshell, this is a very positive news coming in for Swiggy.